Welcome to Financial Repression Authority's Roundtable Insight, where the best fund managers, economists, and industry leaders discuss the key investment issues and challenges in the current macroeconomic environment.
Hi, welcome to FRA's Roundtable Insight. This is Richard Bernoulli. Today we have our guests as Ira Harris and Peter Boockvar. Ira is an independent trader, previous successful hedge fund manager, analyst, global macro consultant, trading foreign currencies, bonds, commodities, and equities for 39 years. Also, he was CME director from 1997 to 2003. And Peter is the chief market analyst with the Lindsay Group and the co-chief investment officer with Bookmark Advisors. Welcome, gentlemen. Happy New Year.
Thanks, Rich.
Thank you. Happy New Year. Thanks, Rich.
So yeah, just to kick things off, Peter, if you wanted to give us your 2017 outlook in terms of what you see happening to interest rates, the financial markets, risk by China, what's happening in emerging markets, corporate tax relief?
Well, the way that I'm describing 2017 is there's going to be this tug of war between the optimism over Trump and the fiscal and the tax and regulatory policies that he hopes to pass and initiate on one hand, and on the other hand, financial conditions that I believe will continue to tighten in the interest rate and, mostly in the interest rate perspective, whether it's Fed-induced on the short end or it's going to be the market that is going to raise interest rates on the longer end. And at least since November 8th, the focus has been on the positives of Trump. And I think when people start looking at the details, number one, of what he's going to pass in terms of what the tax offsets are going to be, I think people have to also acknowledge that what got us to record highs in the stock market was QE and zero interest rates. And that is now reversing. So at some point, I think we're going to shift back to interest rates and the uncertainty of what Trump will pass and the offsets that we'll see in terms of tax policy. And this Trump honeymoon, I believe, ends latest by the 20th of January.
Wow. And Ira?
Well, you know what? It's like Peter and I are sitting with each other. It doesn't surprise me. We're pretty, I think very much the same thing. And, and I'm one who's been in that camp. And I know Peter's been in that too, which is the year-end Trump rally really didn't surprise me. Actually, I was set up for the rally. I was actually hoping for it to break more on the actual election. We didn't get enough. Unless you were up in the wee hours of the morning, you really couldn't take advantage of the 5% decline that we got. But following that, what you failed to see materialize, and I think this would have absolutely taken place if Hillary had gotten elected, was a lot of late year-end tax selling because of people with capital gains, especially long-term capital gains, held back from selling because they thought that they would be walking into as Peter rightly points out, 2017 tax cut. And so why sell now? So you got the best of all worlds. The usual tax selling that takes place did not take place except for losses, which weren't that much because we're almost on all-time highs. We did make all-time highs after the Trump. So I think that set the scenario. And I think Peter's date, January 20th, is probably close to it in so many ways. The United States, the problems that have existed here have not disappeared because Donald Trump, and as people think that this is a Reagan phenomenon, it's not a Reagan phenomenon. There are so many vast differences, and I make my money and get paid for trying to cite those differences. And the most glaring difference, of course, is the debt load that is piled on not only the U.S. economy, but the global economy, unlike in 1980, and that makes this going forward far different.
And I want to just put some numbers behind Ira's point on debt. when Reagan was elected in November 1980, U.S. debt to GDP ratio, and I'm talking specifically about total debt ex financials, was 160%. Today it's 250%. There's $47 trillion of total debt, not including financial debt. So for every 100 basis point increase in interest expense is $470 billion. Now, granted, not all that debt expires in 1 year, but you get the picture. And just to put a number against that, all this excitement over the corporate income tax cut, number one, in 2017, corporations will pay about $375 billion. So there's not much corporate income tax that is paid. And secondly, there's not enough attention being paid to the potential offsets to that tax cut. We have a potential border adjustment tax, which is going to tax the top line revenue at 20% of imports. You have possibly the elimination of the interest deductibility, interest expense deductibility. We have a credit-dependent, credit-addicted economy, and they may be taking away the deductibility of future interest expense. I think that's tremendous. So I just wanted to add some numbers to Ira's last point.
Yeah, thanks, Peter. It's, and I actually had looked at those, and in raw numbers, I think in your percentages, unbelievable. I had blogged about it a couple weeks ago that the total debt in the U.S., the total debt was $5.2 trillion. That's private sector, public sector, state was $5.2 trillion with, I think the GDP, I think Peter's numbers bear out exactly right. I think the total GDP was $3.3 trillion, where that debt, Peter comes up with a far bigger number because it's the global amount, I know.
No, the 47 trillion is actually U.S. Global debt is north of 150 trillion.
I actually, and I'm going to have to go back and look because I had total U.S. at 62.5.
Yeah. If you add financial, it gets up to the 62.
Okay.
Yes. Yeah, I'm talking non-financial, but yes, we're around the same levels.
We're absolutely so, and that has to, as Peter and I will both, I think because we come a lot from the same school of thought, which is that has to be serviced. And Peter makes a point. Yeah, it's not all coming due in this year, but what we don't know, how much of it is floating, just like we got in trouble in 06 and 07, because don't forget, Greenspan masterfully told us, you got to take on an adjustable. You'd be an idiot for not taking an adjustable mortgage. And when those arms exploded, that debt load exploded right with it, and that's what really, to me, caught so many people in a terrible situation for the next 4 or 5 years. And we're going to wind up here again. These corporations have loaded on debt, for share buybacks and dividend payments. And I'm all in favor of dividend payments, but it better be coming out of earnings and not borrowing. And if Trump changes the tax code, a lot of those, which is why, people are running way ahead of themselves when they see the hit to corporate balance sheets when interest deductions will not be part of the equation anymore, just how great the impact is going to be on corporate earnings.
Exactly. And if Trump doesn't get these offsets, let's just say the pushback against the interest deductibility is so high that he leaves it in. Let's just say that the pushback against the border adjustment thing is so large that that doesn't pass. Well, the tax rate, the corporate tax rate's not going to make it to 15 or 20%. Maybe it only makes it to 25%, and the effective tax rate is only 25% anyway. So whether it's tomorrow or January 20th or the day after, people are going to start digging into the details of the Trump plan and realizing that there's no free lunch here. Because of the size and the debts and deficits, you can't just cut taxes. There's going to be an offset and a pay for, and that's what people have to start paying attention to.
It's such a great point.
Also, what we see at FRA is the on fiscal challenges driving U.S. debt. Entitlement obligations are now at 10% of GDP and rising, and this trend is expected to escalate, elevate U.S. debt levels, given the trillions of unfunded liabilities, obligated towards entitlement. So that's a big factor. And then on the private side, corporations have taken out what's been estimated to be about 620 billion, for the share buybacks. And so if rising interest rates begin to reverse that trend, that's a big factor as well that could happen on the markets, going in the other direction.
Yeah.
Oh, yeah, absolutely. There's no question about it. And you already saw Trump today, and I think smartly. I'm not a Trump fan, but I am amazed at through I think it's Steve Bannon's efforts that he's able to control this narrative. It's following in Ben Hunt from Epsilon has written months ago about narratives, the importance of narratives, and Trump and his people are really good at this. And today he came out and said, look, you can repeal Obama, the Affordable Care Act, but you better, be prepared to accept the responsibility of it. So proceed cautiously. And as we know, I've grown up, I'm 63 years old, and I've ad nauseum have I heard Social Security being the third rail of politics. Well, once you give something to somebody, you're going to have to be very cautious because you will wear this around your neck for all the people who get disenfranchised. And I think Donald Trump fired that warning shot. Oh, yes, we're going to do this, but don't take a slash and burn approach. So we're already seeing some, political maneuvering here.
Yep, agreed. This is a lot of. We're about to see the difference between campaigning and governing, and the realities of the latter.
I couldn't agree more. I think it's so dead right on target. And they're good at it. And Steve Bannon, he knows how the media game is played, and they're playing it right at this point perfectly. So, and that's going to have even more market impact. I can't wait for the days of Twitter to stop moving markets. I tweet my blog out, but that's it. And people say tweet more. I go, absolutely not. How can you? Whatever you got to say, you can't say in 143 characters. At least most people I know.
Yeah.
Most people I know. You might be able to say it in 300 characters, but you certainly can't say it in 143 characters.
So we see FRA four key themes going into the new year, as worsening public and private debt, a stagflationary global economy, an emerging public and private pension crisis, and the unsustainable entitlement obligations. How do you see on the global economy? Do you see rising inflation as well as slowing growth, and how will trade affect that in terms of potential movement towards protectionist measures? Anybody?
On growth, right now, U.S. growth is going to end 2016 at still around the same 2% level that we've seen for a while. The question for 2017 is not necessarily the actual Trump policies, because if he passes something, we're not going to really experience the benefits until 2018. It's a lot of the positive sentiment numbers that we've seen in manufacturing and services and consumer confidence and builder confidence. How much of that is really just hopes, and how much of that spills over into actual improvements in business activity? I think it's more just hopes, at least right now, and that we're still going to see GDP in 2017 at around the 2% level, and that the benefits of Trump we may not feel until 2018, and that's assuming no sharp rise in interest rates. The inflation numbers are moving higher, partly due to the rate of change of the base effects of taking out the decline in energy. So you're going to see 2% headline within the next couple of months, on top of high prices of medical care and rents and other services. And commodities generally, not just energy, commodities generally that have stopped going down. We saw a 1.7% print yesterday in German inflation. We're seeing inflation expectations rise in Europe and in the U.S. And then it gets down to, well, how does the Fed respond to that? And if the Fed's not going to respond to that, well, how's the long end going to respond to that? What's Draghi going to do if all of a sudden inflation quickens more than he thinks? Is he going to continue QE all through 2017? My point of all this is that interest rates mug the markets and trump of reality. And I want to point out again, what got us here was QE, negative interest rates, and zero interest rates in the U.S. And to think that that can reverse with no pain, and somehow fiscal policy is going to offset that, I think is delusional.
Yeah.
You know what, Peter, it's just, I'm in a lot of amen corner here today, but these are areas. But I think the most important area, this is for me, and Peter touches on it, is going to be euro.
Yes.
Because as Peter talks about, now we saw the last few German inflation numbers have been kind of interesting. And we know that that's where the problem is. Don't forget the rest of Europe, everybody but Germany and probably Finland and the Dutch, they want the Germans to have higher inflation because that's the only way out of some of the mess that they're in, which is, of course, a phenomenal debt overhang. And the engine, I had blogged about this last week because I went back and I'm looking at it, and I'll make Peter laugh here, is right now I can sit and tell you the present day value of the German D-mark. Right now we're trading around 186.87. It's a synthetic way. So,
that's impressive.
So then, and when you think when the euro came into being, the equivalent value of the D-mark was 1.66 in January 1st, 1999. Now, back then, the German current account was actually in deficit a little bit because, all the impact from reunification, the cost of paying for it. And right now, with basically the D-mark 10% lower, the German current account surplus is ridiculous, the most ridiculous in the world. I think it's about 8.5%. I could be wrong, but not by much. About 8.5% of GDP. It makes China's look laughable, and yet there's not a damn thing they can do about it because Germany is tied into this weak economic consortium, and they're benefiting from it with phenomenal growth relative, of course, foreign investment and, of course, exports. And everybody else who's saddled in there cannot get out from under this because the weaker the euro goes, the more benefit Germany gets anyway. So Spanish manufacturing doesn't all of a sudden become competitive. The Italian manufacturing sector doesn't become competitive. So this is the year, I'm pretty sure we're close, if not this year, next year, where Germany is going to have to make a decision. Will we be the transfer agent for all this beneficial economic growth, or do we say enough's enough? So the markets are not geared to look at this whatsoever. They're so enamored with Draghi, as Peter rightly says, and what he's doing, and they're watching. But all Draghi's doing is trying to create a harmonized fiscal situation through the back door by building so much debt onto the ECB balance sheet. And to me, the operative question for this year is, as it was last year, who guarantees the ECB's balance sheet? Now, I asked this question, Peter. I was at a symposium in June, right after the Brexit. Jerome Powell was speaking in Chicago at the Global Initiative. And I asked him that question point blank about the ECB. And of course, his answer was what I would expect it to be from them. They have a printing press. Well, that's where it resides. They have a printing press. You take that as a may. I'll take it as a may. But as I saw the German inflation numbers, it may be one euro, but whose euro is it? We're going to find out this year.
Yeah, no question. And if there's one thing that takes away that printing press, it's inflation that moves higher than central banks are prepared for. And we're going to see firsthand that the fallacy of desiring 2% inflation. I mean, Draghi, I guess, doesn't realize the epic bond bubble that he has created. When you have huge amounts of negative yielding bonds in Europe, obviously mostly on the shorter end, and anemic long-term levels of interest rates. At the same time, he wants 2% inflation. So what's going to happen to that German Bund when he gets his 2% inflation? Well, it's most likely it's not going to be trading with a yield of 27 basis points. So he's desiring something that is going to blow himself up, and it's a very dangerous desire on his part. But he's apparently willing to push the pedal to the metal in order to get there, and I think he's playing with fire.
Yeah, I agree, and I really think that as 2017 unfolds and we get beyond the Trump hoopla, Europe becomes the centerpiece of the global financial system. Because if Europe blows up, all bets are off as far, because I don't care whose models you use, whatever you have, there's no way that they have priced it, and they couldn't price Brexit. And Brexit, as we know, was really a non-event as far as the markets were concerned. Trump was, again, a non-event as far as the markets are concerned. But I'll tell you what, an ECB balance sheet of 2.5 trillion to 3 trillion euros, that's nothing to sneeze at, and especially when you have all those banks who have, through the magic of the ECB printing press, through Target 2 funds, have taken all this risk on their books. And again, they carry all those sovereign bonds, which is the most dangerous thing. They own Italian bonds, they own Greek bonds, all carried at a zero risk weighting. It doesn't take much to do the math to figure where the real danger point is in this game.
Yeah, and I want to add to that it was a 50% decline in the equity value of Japanese banks. It was a 50% decline in the equity value of European banks that finally was a knock on the door of the BOJ and the ECB that flattening your yield curve into the ground was probably not a good idea.
Yeah.
And I think that was the first sign when we saw a rise in longer term interest rates in Japan, and I'm talking about very longer term, 20 years, 40 years out, that central banks were beginning to, that it was a sign that we were in the last innings of this modern day extreme monetary extremism. And we have the ECB as of April that's going to be cutting its QE from 80 billion euros to 60 billion euros. Now, granted, it's going out to December, but my point is we are in the last inning of this bout of monetary easing. And it comes when the global bond market, in my opinion, is in the biggest bubble of any bubble we've ever seen. And right now we're in this window of Trumponomics and the optimism around it, but people should not lose sight that interest rates, while still extraordinarily low everywhere, are going to be moving higher over the next couple of years, and they should be prepared for that.
Mm-hmm. Yeah, it's sort of like a move to other types of or other pillars of financial repression, away from low or negative interest rates towards more forced inflation, obfuscation of data and news, as well as ring fencing regulations, sort of moving into other areas of financial repression. Do you not agree?
Yeah, no question.
By design.
Yeah, exactly, yeah. By design.
Mm-hmm.
But I think that the markets are beginning to take some control. I mean, Janet Yellen has two choices this year.
Yeah.
She either drags her feet, as she has for the past many years, particularly over the past 2 years by raising only twice, and the bond market is going to revolt against her. Or she can get more aggressive with rate hikes and get back control of the market, but at the risk of pushing the U.S. economy into a recession. Either way, this is a very difficult situation that the Fed has put themselves in. But either way, we're going to get the rise in interest rates. And we have a very interest rate sensitive economy, a very interest rate sensitive equity market that for right now is looking at the world as okay, but which begs the question of what level of interest rates will it shift to the other direction. But don't be naive to think that's not going to happen at some point.
Yeah, I think that's absolutely well stated. And Yellen's been able to get away with it to a certain extent, of course, because you've had the ECB and the J. Don't forget the BOJ. So there's 160 billion of bank buy-in every month of sovereign debt of asset purchases. So that gives you some leeway. But you know what? Even with all of that, you are still getting some rise in rates, and that is the market saying, look, we are fighting back and we are pushing back, and we are going to demand more in yield in order for us to keep buying what you're pushing down the pipe as. But we are getting close to game change time. I'm a believer that Yellen will drag her feet anyway, and that Draghi and Kuroda give her some cover for that. But and Leo Brainerd, this will be interesting because I think she's probably the most dovish voice there. And when I peruse the minutes today, there's no question that the 13 allusions, I think it was, to the strength of the dollar as a headwind. I mean, to me, that's Brainerd 101. So,
and I think we use every excuse not to hike.
Yeah. First of all, because they want wages to go up. They think that they can stop the inflation, but if they get the wage gains, I really believe that. I will always be of the camp that Janet Yellen is first and foremost a labor economist, and she will err on the side of the benefits falling to labor, even though we know the illusion of money. It's a false dichotomy, but whatever. She feels it, and rightfully so. I'm not disagreeing with her moral judgment that the middle class in America has gotten short shrift for the last 25 years. Absolutely. But it's not her job to correct it. And I think she's going to play a very dangerous game.
Yeah, agreed. I mean, as of 2015, so a little more than a year ago, the profit pie, labor or employees got the smallest share since World War II. That's now beginning to shift, and we're seeing that in a compression of profit margins. But there's a lot of catch up on the labor side in terms of wages. And while it will be good for those earners, it's not going to be good for corporate profits. And companies will have two choices: either slow down hiring and absorb those higher labor costs, or pass it on through higher consumer and product prices.
I 100% agree. And Wall Street is not priced, I get, for that at this moment. It boggles my mind, but I know, or at least I think I know and understand their models. And of course, as we know, all models are based on certain assumptions, and I disagree with their underlying assumptions. So I don't believe that their outcome. I understand their exuberance. I understand less regulation, lower taxes, but as we know, the legal process or the legislative process is like sausage making. And if they think they're going to get everything they want just because there's two houses that are in Republican hands and the White House, I would be very careful what you wish for here, because there are other dynamic forces in play that they're not pricing in.
And what about the effects of China and all this? So on fiscal policy, on monetary policy, I mean, right now, non-performing loans in China are, according to Moody's, 15% to 20% of GDP levels. So, although it's still a little bit lower than Italy, where it's about 25% of GDP levels. How does the China factor weigh in? Especially given trade issues or potential trade tariffs of being administered by the Trump administration, which could be offset by a devaluation of the Chinese currency, significantly to negate the trade tariff increases. Any ideas?
Well, I mean, China's fallen into the same trap as the U.S. did, where it's taking more and more debt to generate the same level of GDP. So this obsession with 6.5% to 7% growth has put them in this trap. Rather than just letting growth be where it's going to go, the level of credit to generate this GDP is almost out of control. It's now out of their control. And listen, I give the Chinese credit in that they acknowledge the problem that they have, but they're so worried about a disorderly unwind of it that they keep seemingly to fight the slowdown to try to make it as orderly as possible. But that then creates its own unintended consequences. So I think the end result is growth will continue to slow. This debt is going to become a big problem, but China is one big black box in the sense of they could throw a lot of things under the rug and keep it there in some controlled way. So it's easy to give the gloom and doom on China, but it's very difficult to try to forecast how Chinese authorities are going to manage that.
Yeah. Ira, any thoughts? Or?
Yeah, I think you know, I always am careful. I'm not known to be a cautious or careful person, but when it comes to China, because, you know, my attitude for the last 10 years has been, look, if they don't allow Google to operate, I don't trust anything that comes out. It's the most manipulated data, and I know there's really high quality data that privates do, but I'm always skeptical because we never get. I don't think we get a third of the real story, but we'll know. And I think Peter didn't discuss this end of it, but if China were to implode, if China were to float the currency freely and it were to depreciate, then a lot of us would have to change our scenarios, because it could send a tidal wave of disinflation around the globe, because they will be just exporting and regardless of price and sending things around the world. Because they, you know, the problem will be today, it was yesterday, and it will be tomorrow, far too much capacity. You know, unless they can miraculously shift that economy from a export-oriented to a phenomenally domestically based economy. But of course, with that debt load, it's going to be not an easy task. It'll never be an easy task, but it gets harder. So there's so many question marks. I don't know. And you know, to me, as I tongue-in-cheek always say, they're better at manipulating the data than Jack Welch was while he was at GE. I never saw earnings come in a penny. You know,
and he was really good at that.
Oh, he was masterful at that. I know, except I'll watch myself. But you know, they too. How do they hit these numbers? I just laugh. I go, really? Yeah, seriously. But I will say that one of my things that I will watch about China, because if China is going to make the transition, and Peter rightly talks about some of the potential political disruption that there will be, food will be an important thing. And I stayed bullish global food prices, because we've gotten record supply for the last few years, and food prices still remain historically fairly strong. And I'm talking about, you know, the grain markets especially, and meat markets. So China will be careful to make sure that there's enough food to feed everybody, you know, as they start to make some of the transitions.
Yeah, I agree with that. I'm bullish on agriculture as well.
Yeah, exactly. So given all this, gentlemen, how do you see the commodity markets, equity markets, both developed and emerging markets, bond market and currency market shaping up for this year? Peter?
So I'm most bullish on agriculture. I was bullish going into the last year on industrial metals solely because of the supply response that was gaining steam to the lower prices, not because I saw a pickup in demand. But industrial metals have had a nice move here. So while I think that they're not going to fall back, I think further gains in the short term at least will be more muted. I'm most positive on gold and silver, but even though I don't consider that a commodity, I see that more as a currency. I know everyone's obsessed with the strong dollar, but the last time the dollar was at these levels was 2002, and gold was $350. So anybody who traded gold off the dollar would have missed an $800 rally over the past 14 years. Gold's going to trade where real interest rates are. And if you think, as I do, that Janet Yellen will be very slow in raising interest rates in response to a rise in inflation, then you should be positive on gold and silver. Gold and silver have handled now 2 rate hikes. They've handled a 14-year high in the dollar. They've handled a rather sharp rise in long-term interest rates. They've handled big interest rate differentials between the U.S. and overseas. And it's still $100 off its lows of last year. So I think that was the bottom in this bull market, or I should say in the bear market. bull market's resumed, and I'm expecting higher prices. Now, with respect to emerging markets, I'm positive, but I don't like to brush emerging markets with a broad brush because that includes Venezuela and Turkey. I'm not necessarily bullish on them. I particularly like Brazil. I like South Korea. I like the political change that's happening in those countries. And notwithstanding the disastrous demonetization in India, I still want to believe that Modi's business-friendly, again, notwithstanding this currency mess that he's created, I think once they get past that, there's a lot of optimism, I believe, in a country that has amazing demographics.
And Ira?
Well, Peter and I, it's like we didn't talk. So on the gold and silver, I couldn't agree more. That 1048 area that we visited last year, which to me is a critical area, because that was the November 2nd, 2009 price when India bought 200 tons from the IMF in the last big gold sale. And the Chinese were very upset that that sale took place because they wanted to buy gold from the IMF. I think that proved itself, and I think Peter's right. As long as, and I'm of the same camp. People say, well, when will you be bearish the metals? I said, when short-term real interest rates go positive, you will see the greatest bear seller. That will be me. I will turn. But we're not there. And steepening yield curves, I listen to these idiots in the media, like the long end. The long end does not, right now, the algos are built to like 10-year yields driving gold. That's a farce. Because all you're seeing is the curve steepen. Right now, we're not seeing anything but the curve steepen, which says that the world is growing a little tired of the role of central banks in directing the financial system, and they're getting nervous because the central banks, of course, will move, as Peter says, the Fed will move grudgingly, and we just saw the ECB actually go the other way because when they took off the gloves on the low level that they could purchase of debt, that was, to me, a phenomenal rate cut. Because all of a sudden, German paper, which couldn't be bought because it was below the negative 40 basis points, they can buy all they want now. We saw the effect was the German 2-year paper went from negative 57 basis points to negative 81 before, by the end of the year. So all these things play well into gold. And if you see the German inflation numbers, if you're a German citizen and you're not buying hard assets, be it real estate or metals, you're an idiot. Because they're telling you they're debasing your currency as a way to bail out the EU. You're an idiot. You know what? And I have a lot of German readers, and I'm going to say that. And the Germans are far from being idiots. But what they're having done to them, it's a classic debauchement. And Mario Draghi is debauching the German currency.
Yeah,
which is why I'm bullish. I'm sorry, Peter, go ahead.
Yeah, no, I just want to add to that. Anybody listening should look at the chart in Bitcoin. Bitcoin is up 150% year over year. It has gone from just over the past couple of months, it's essentially doubled. So there's something very wrong that Bitcoin is doubling like that, and gold is suffering because people are watching it against the dollar. People are buying Bitcoin because of what Ira's saying, and there's this push for non-fiat type currencies, and that if you're Germany, you want to be buying gold. If you're in India, you want to be buying even more gold. If you're in China, you want to be buying even more gold. Right now they're buying Bitcoin, but the discrepancy between gold and Bitcoin is nonsensical.
It's funny. The guys who I work with, and we're back in Chicago, I'm down in Arizona, spending some time as I'm getting older. And because they were talking about Bitcoin, we were watching it. And I said, Bitcoin to the Chinese, it'll make the Chinese into the Hunt brothers because, it's a small market. You can push it wherever you want. You can just post whatever price you want and keep bidding. You know what? Give me gold over Bitcoin. Ben Bernanke may not understand gold and he understands Bitcoin. I understand gold a whole lot better. And Peter's right. It's not a commodity. It's a currency. It's a haven and a store of value. And you know what? Bitcoin will have another and another and another problem at some point where somebody will find a way to raid the hoard or take the money out of the Bitcoin wallet. I know what gold provides to me, and I know debasement of currency. When I see debasement of currency, I just wrote a piece in today's online foreign policy where somebody said Merkel's problem is going to be Bavaria. But of course, the narrative that the elite, meaning the Washington, New York, and Brussels elite want to spin is that anybody who votes against Merkel is really just a racist and a know-nothing, as we would say, going back 150 years in American politics. But I'll tell you what, the ECB will become the big issue for the German elections come September. Because people, don't forget, the Alternative for Deutschland party was basically started by economists who were railing against, back then, the ECB policies. And you've seen Wiedmann of late, and I have great respect for Jens Wiedmann, pushing back against Draghi. This will break out into open warfare between the Bundesbank and the ECB as we march on.
Couldn't agree more.
Well, that's great insight for the coming year, gentlemen. And for our listeners, how can they learn more about your work and also, Peter, if you'd like to highlight your new service, the Book Report, Peter?
Sure. People can access my work through www.bookreport.com, and it's spelled BOOCK report.com, and you can subscribe.
Okay, great.
Peter, I will be subscribing to it. My got his notes from underground, and Peter's on with Rick Santelli as much as I am. So you get his insights, and he's one of the few people I turn up for. Or most people Rick Santelli has on. I'm biased. I admit my bias, but there's a lot to be gleaned, and I always listen.
Yes.
So I'm glad that Peter's out there doing this because. Again, we agree on a lot of things. We don't agree on everything, but I think we see the world and where the pratfalls and the real potholes to this year is going to be, and it's not going to be from Trump. We unfortunately live in a U.S. centric world where we think that the United States controls everything and we're the basis of all important news. Hey, I'm sorry, there's a lot more going on. And just to pick up when Peter talked about some of the foreign currency too, and I know we'll get into it another time. This Mexican peso bears watching, and its real value comes in relative to the value of the Chinese yuan going back to 1994. The Chinese yuan was devalued again on January 1st, 1994, the day that NAFTA commenced. They depreciated it from 5.8 to 8.7. A pure 50% devaluation. Go look to see where the peso was at that day. I think it was about 3.2 peso to the dollar. Today we're 21 pesos to the dollar, and the yuan is sitting at 7 yuan to the dollar. So there's some interesting things that are going to be taking place in the emerging markets because of that. But right now the markets are just enamored with whatever models and algos that they've been working off of. But I think 2017 is going to see a return to a lot of the fundamentals. I think that Peter and I would admit that we hold dear to. Not that I'm going to trade that. The market is what the market is, but there are underlying fundamentals there that will start to rise to the occasion and will make our work and our views even more valuable going forward.
Great. Thank you very much, gentlemen, and we'll be back next week for another Roundtable Insight discussion. Thank you.
The FRA Roundtable Insight Show is for informational and educational purposes only and should not be considered as a solicitation or offer to purchase or sell any securities. The investments, investment strategies, and investment philosophies discussed or presented on the show each involve their own unique risk factors which are not discussed on the show. Any discussions among the panel participants or responses to listener inquiries are based on the personal opinions of the panel participants and do not take into consideration the listener's suitability, objectives, or risk tolerance. Please be advised that you invest or speculate at your own risk.